Growth engines are humming all over again. Indian economy grew at a healthy 8.2% in the first quarter, and that is exactly what we will be putting the spotlight on this edition of the India Development Debate. Good evening, I'm Supriya Shrinate. Remember, this growth was led by manufacturing sector, which saw a robust growth of 13.5%. For the first quarter of this fiscal. The icing on the cake is the spike in farm growth at 5.3% over the same period, which recorded 3% growth last year. In fact, the Q1 GDP growth is far ahead of the estimates by the Central Statistician's Office and also by the Central Bank. Economists say, though, that the Q1 GDP data is a clear indication of a bounce back, though the numbers may have got a big boost because of the low base effect. They also point to a pickup in capital formation, which showed a growth of over 10% during the first quarter. The state of the economy is a big topic of discussion and debate right here on the India Development Debate tonight. And before I go to a debate, it is time to get you a direct conversation with my very special guest. Dr. Rajiv Kumar, Vice Chairman, NITI Aayog, joins us right here on the show this evening. Thank you very, very much, Dr. Kumar, for being with us. I think as an economist, it's only fair I begin this show by congratulating you on that 8.2% growth. But is it too early to celebrate that growth, given it's come on a low base effect? I'm supposed to be a skeptic, so I'm going to ask you those questions. Is this going to be sustainable over the next 3 quarters? And the question also is, where do you expect fiscal year 19 growth to end?
Yeah, Supriya, hi, great to be here. And you know, I'm sure you remember that last July, I had said that the first quarter growth of 5.6% was the lowest point of our economic cycle, and henceforth there will be a recovery. And that is what it has been. But the best news, therefore, if you look at those 4 quarters now, is that there has been a steadily rising growth momentum quarter after quarter after quarter. You know, so the second quarter of last year, and now you compare it, there's been a rising momentum, and this momentum is bound to continue because it is clearly the upswing of the cycle. And as you just said yourself, it is now beginning to be reflected in much higher growth rates of the gross fixed capital formation. So the investment engine is beginning to go again, the private investment is beginning to go again, to hum again, and therefore the economy is finally firing on all fronts, on all the engines, and I cannot see any reason for anybody to be skeptical about the growth momentum, the growth trends going forward. Those of us who are talking about low base, etc., I mean, come on, I mean, you know, you could say this about the manufacturing sector, where the Q1 growth last year was a negative one, but 5.6% being a low base, since when has that become so? And then on agricultural growth, there is a 5.3% growth rate over a 3% growth rate in the previous quarter, compared to a long-term average growth rate of the agricultural sector about 2.6%. So I mean, this is being crybabies. Right. I mean, this is being unnecessarily, you know, sort of, unnecessarily negative when at this point of time, when we must celebrate the fact that our economy is beginning to hum again, and the economic cycle is on the upswing for sure.
Right. Dr. Kumar, I am one of those people who firmly believes that growth is the tide that will lift every boat, and it is important that India sees high economic growth. So I'll keep my fingers crossed on this, but I will ask you a more pragmatic, realist question. Isn't 8% utopian given the present global conditions around us, the kind of trade tension that the world is witnessing and the kind of currency, slackening that we are seeing, a very worsened rupee? These are obvious pockets of stress, aren't they, going forward?
Supriya, three points here quickly. One, you know that the largest economy in the world is experiencing the highest growth rates for a very long time. I am talking about the US, of course. And also there is somewhat of a synchronized recovery between the US and Japan, again after a long time. And so therefore, despite the fact that you've got all these bad noises coming out on the trade front between the US and China, etc., the economic growth rate, the global economic growth rate hasn't slackened, has not slackened despite all the turbulences that you see, and that is principally because of a huge technological and productivity gains that the global economy is beginning to benefit from. Second one, you would have noticed that all the currencies have declined against the dollar, In fact, India is one of the two currencies which has done much better compared to the others vis-a-vis the dollar. So the rupee decline is not about the Indian conditions, it's more about what's happening to the dollar and the strengthening of the dollar as we have seen over the last many months now. And the final question is that yes, the global turbulence could have hit us, but we should change that, we should become much better off, but our dependence on external demand is not that high. We still have our export share has in fact come down and is not so much, and we have been a net negative external demand economy. So we are to that extent getting this growth momentum because of domestic factors, because of the rise in private consumption expenditure, because of now an increasing investment expenditure, and I think this is where I feel much surer about this momentum to continue than I would have been otherwise. And you had asked me about
Dr.
FY19
Kumar, you're right that
growth.
the gross fixed capital formation
to 8%, then to 7%.
Okay, interesting. You expect growth to be closer to levels of 8% and not 7% as former Finance Minister Padappa Chidambaram has tweeted today. But, talking about gross fixed capital formation that you alluded to, which is private investment, it has grown at 10%. Is private sector finally getting its mojo back? I mean, that's really the broad question that I'm asking because, every time there is some pickup, we say private investment has been crowded in. But has that really happened? And, it's a big positive. All I'm asking is, has it happened? And when are we going to see the obvious consequence of that, which is job generation, which is employment opportunities being created on account of GFCF going up?
Supriya, I must first come to the employment question. All of you just persist in asking this question, and the simple fact is that you cannot get an 8% real rate of growth without employment. We are not in the business of raising labor productivity by more than 6, 7, 8%. I mean, that's just simply impossible. You just can't. If you do your simple arithmetic right, it cannot be without the jobs. The rural real wages have been rising at 4.5 to 5% for the last 3 years. Such a wage rise does not happen when there is joblessness in the urban sector, because that leads to workers going back to the villages and wages there falling. So there are so many indications, evidences to show that there has not been an employment, there has not been any increase in unemployment. You've got all the data that we have been able to put out, which shows that there is a steady increase in it. But I am very surprised to see that this narrative continues. I do not know for what reason. There is just one source which I do not want to cite, which gives you the negative figures, and we continue to, for some reason, cite that. Now, on the private sector, thankfully, it is back. The private investors have got their mojo back, as they are saying, and this is reflected in the very smart improvement in corporate debt and the stock of corporate debt, which has improved significantly over the last 1 or 2 years, last 2 years, and also the improvement in the IPOs that you've got, and FDI. You got 36 billion in 2013-14, is now going to touch 72 billion this year. Now, all of this is private investment, and this is substituting for a weaker but now rising, credit offtake from commercial banks, and especially the private sector banks, because a large number of the public sector banks are under the preventive and corrective action.
Okay. Dr. Kumar, I'm going to take a last question before I let you go, and this question is a topic which is a favorite of mine and of yours too. Have fears around the fiscal deficit decelerated, given that the total deficit so far this year is 86.5% versus 92.4% last year? Spending has been only 36.4%. Does this now give the government enough elbow room to perhaps indulge in a little profligacy in this election year? Have fiscal concerns been decelerated?
No, fiscal concerns have thankfully receded, but cannot be any cause of complacency. we have to be on our guard. We have to be very sharp about this. We know, we got to be careful. We have to see how the GST revenues are shaping up. Whether they are going towards a lakh crore per month or beginning to sort of, as it were, stabilize around 95,000 crore. But as you know, I have always insisted on focusing on the revenue deficit rather than the fiscal deficit. So, come the need, if you like, to give another push to the economy by, for example, working on the, by preventing any further oil price hikes, etc. I would always be backing that, because I am not a fiscal hawk. I am not somebody who looks at that as a sign of macroeconomic stability, but much more on the revenue deficit. But we have to be constantly on our guard to ensure
that we are
not being fiscally profligate.
Right. Okay, no fiscal profligacy. You have to be on your guard. Can't let your guard down. Thank you very, very much. The Vice Chairman of NITI Aayog, Rajiv Kumar, talks to us exclusively right here in NITI Now on a day when India reports an 8.2% rate of GDP growth. Remember, this is the highest in the last 9 quarters. This, of course, has got the politicians and the economists divided as well. It's time to turn the focus to the debate tonight on the India Development Debate this evening, joined by a list of prominent economists.